In this video, we're going to be going over exactly how much dividend income I made in the month of October from a $244,000 account, and to break this down, we'll be looking at my investment dashboard, my dividend dashboard, dividend calendar, daily dividend calendar, and like always, we'll be projecting out what my portfolio will look like in the future so we can see exactly how long it will take me to achieve my long-term goal of one day being able to live off dividend income. And like always, if you'd like to be able to download this spreadsheet or get access to any of my other ticker data spreadsheets and the ticker data add-on that allows you to automatically import stock financials directly into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now let's go ahead and dive into the video. If we go ahead and zoom in, again, we can see portfolio value right now is sitting at about $244,000, and around $71,000 of that comes from gains, which means total returns is about 38%. Now, it's extremely important to note that this is a money-weighted return, not a time-weighted return. I see some people in the comments occasionally make this mistake. Your brokerage will typically show you a time-weighted return, but again, this is a money-weighted return. So essentially, because I'm continually adding new capital to the portfolio every single month, it's going to lower this return right here. So in reality, the total returns are significantly higher. Now, if we keep moving forward, we can see my allocation. Now, I have a long-term time horizon, so I'm completely comfortable with being 91% in stocks. That doesn't bother me whatsoever. We can see my cash position at about 8.9%, and total holdings is currently sitting around 30. I have a few positions I'm probably going to be trimming here in the next few months, so I'll aim to get this closer to around 25 to 27. Now, if we look at the cost and market value and growth charts, what we can see is essentially the performance of each of these positions compared to how much I originally invested. So for example, Microsoft, I put in about $9,000. Meanwhile, the current market value is over $18,000. So if we come over to my growth chart, we can see Microsoft position currently up about 106% on Microsoft. Now, that's phenomenal. Obviously, I've loved Microsoft. It's one of the largest positions in my portfolio, but there's some other positions that have performed extremely well. And obviously, the huge outlier here is Broadcom. This company just continues to outperform. It's pretty mind-blowing what it's been able to achieve. I invested in this stock a few years ago. I made a video on it, and the company's up over 656% right now. But again, there's plenty of other winners in my portfolio. Caterpillar is now up over 233%, nearly 234%. This was a very under-the-radar position that I added to my portfolio, and it's quietly been outperforming the market. If we look at JP Morgan, this has been a phenomenal stock, up 192%, and there's been quite a few bank stocks that have done well. Also, I own Bank of America. I'm up over 100% on my Bank of America position now. Another financial stock that's done extremely well, Jefferies Financial, I'm up nearly 81%. Now, what you'll notice about most of these stocks is they're dividend growth companies. They're companies that don't necessarily have very high starting dividend yields right now, but because they continue to grow their earnings and grow their free cash flow over time, they're able to grow their dividend payments at a high rate. And what we've learned from market history is dividend growers typically outperform the market over the long term. Now, why is this the case? Well, you have to understand what actually drives dividend growth over the long term. Let's look at Microsoft as an example. Again, thanks to ticker data, the data will load in. Now, what we have to understand is free cash flow. And we have to understand the main priority for management teams is capital allocation. How are they going to use free cash flow to reward their shareholders? And they have 5 options. They can reinvest back into the business, they can pay down debt, they could do mergers and acquisitions, they could buy back shares, or pay out dividends. So a lot of the times, these stocks, as we can see here, like Microsoft, that have grown dividends at a very high rate over the last decade, have low free cash flow payout ratios. Why would that be the case? They're only using 30% of their free cash flow to pay out dividends. They could pay out a lot more in dividends if they chose to do so. Well, what that would do is prohibit them from heavily reinvesting back into the business. Because companies like Microsoft heavily reinvest back into the business to continue to grow free cash flow year after year, free cash flow grows, and then their ability to continue to grow dividend payments at a high rate grows as well. So what we have to understand is share price appreciation and dividend growth are both byproducts of growing free cash flow. This is why dividend growth stocks get the best of both worlds. And as we'll see just a little bit later in the video, a lot of the times over the long term, dividend growth stocks actually pay out more than high yield stocks. Now, with that being said, I'm not anti-high yield, not whatsoever. In fact, I own just a few high yield companies in my personal portfolio, and the ones that I've held for some time have actually done very well. EPD, this is a stock yielding in the 7 to 8% range, and I'm currently up about 64% on this position. Then we have Altria. It was yielding over 8 or 9% when I originally bought it, and I'm up about 64% on this position. This belief that high yield automatically equals high risk is not true whatsoever, but you do absolutely have to know what to look for. And over on Dividendology.com, there's a link in the description. I've been putting out a lot of research on high yield investments, and I'm even building out a real money high yield portfolio for people that want to follow along. So be sure to check out Dividendology.com at the link in the description. I'll also go ahead and put a QR code on the screen now if you want to go ahead and scan. Now, the last thing I want to point out on the growth chart is I did add a new position to my portfolio in the recent month, S&P Global, SPGI. Now, there's a few reasons that I'm actually pretty excited about this company. Now, to start, we can see they've certainly underperformed in the last year, trading pretty flat, and year to date actually down by about 5%. And again, this is something I was talking about over on Dividendology.com. I put out every single month a list of undervalued dividend stocks. And one of the things that I was writing about that I love about S&P Global is that as of 2024, around 96% of their revenue was recurring. I love buying businesses that have recurring revenue. It makes their future cash flows extremely predictable and extremely stable. On top of this, it's an incredibly capital-light business. What does that mean? Well, we can see right here in 2024, they had a free cash flow margin of 39%. So basically for every $100 in revenue they generate, $39 becomes free cash flow, and like we just mentioned earlier, that's essentially capital that management can use to reward shareholders, and it's the reason that S&P Global will be able to continue to grow their dividends at a high rate moving forward. And purely from a valuation perspective, we can see they're now trading at their lowest price to cash flow ratio in the last 3 years. So again, there's plenty more I could say about S&P Global, but I don't want the whole video to be about them. So if we keep moving forward, basically up here we can see my allocation by each individual stock. I do have a decent bit of capital in the dividend ETF SCHD, nice yield, and phenomenal dividend growth rates. And then we can see my largest individual position, Microsoft, at about 7.5%. And then we have Visa at about 6.2%. And coming in at number 3, we have Broadcom at around 5%. Those are my 3 core positions, the 3 largest individual positions in my portfolio. And people look at them and they see those low yields, but these are companies growing free cash flow at double-digit rates and increasing their dividends at a double-digit rate. And again, I'll show you why that's powerful here in just a moment. But if we come down here, we can see my allocation by individual industry. You can see I'm pretty heavily into tech, about 19%, financial services, about 13.2%. We just look at energy, 3%, healthcare, 5%, consumer defensive, 4.2%. Come down here, real estate at about 6.3%, industrials, 3.2%, and consumer cyclical at 6.5%. Now, there's more that we could break down, but we'll come back and look at this just a little bit later. Let's go ahead and jump over to my dividend dashboard to answer the question everyone wants to see. How much did I make in the most recent month? So if we go ahead and blow up my monthly dividend income chart, what we can see is in the month of October, it looks like I made $308.46. Now, if this is the first time you're watching one of my monthly portfolio update videos, there's typically one comment or one thought that I see pretty often from new viewers. And for a portfolio that's over $200,000, $300 a month in dividend income doesn't seem like a whole lot. And you're correct, but you're not seeing the full picture. There's a couple of things we have to point out that I always point out. Now, to start, you can see this was expected to be one of my lower months. I typically have a couple of lower months followed by massive months when SCHD, the dividend ETF, pays out, and I'll typically make around $1,200 when that happens. And for reference, you can actually see my average monthly dividends is sitting at about $618 a month. But the other thing we have to point out is, again, it comes down to dividend growth. What we're seeing charted out right here is a monthly payout comparison of a dividend growth stock versus a high yield stock. What we can see is, yes, high yield will absolutely pay more in dividends in the short term, there's no doubt. But dividend growth stocks that increase the amount they pay out in dividends by a high rate over time will eventually start paying out more than high yield companies. Now, this is an example if we don't reinvest dividends, but it's still true even if we do reinvest dividends, it just takes longer for dividend growth to actually surpass high yield. This is such an important concept to understand, and it's why I discuss it in nearly every single portfolio update that I actually have. So yes, I could absolutely be making a lot more in dividend income every single month if that was my primary goal. But immediate dividend income right now isn't the goal. It's maximizing dividends over the long term, because that will help me achieve my long-term goal of living off dividends at a faster rate. Now, if we keep moving forward, we can see my portfolio value over time. If we look at this charted out, I'm pretty happy with the way that it's trending, obviously. Again, it hasn't been hard to make money over the last 3 years, but portfolio value currently sitting at about $244,000. Now, we can see my expected yearly dividend income climbed quite a bit in the recent month. It's now sitting at $7,424 every single year. Again, I already pointed out the average monthly dividends at about $618 and my all-time dividend income over $16,400. Now, if we zoom in, let's take a look at my dividend yield on cost. And this is a great example where we can actually see the power of dividend growth. And the example I always like to use is Broadcom, because we can see my yield on cost is about 4.55%. But what's interesting is, let's jump over to Seeking Alpha. Seeking Alpha is a great tool. I have a link to it in the description. But if we look at Broadcom, what we can see is right now, their forward-looking dividend yield is just 0.61%. So my yield on cost on this position is significantly higher than the current starting dividend yield. Why is that the case? Well, yes, I did buy this stock at a better valuation when the starting dividend yield was high, but at the same time, this stock has increased the amount it pays out in dividends at an incredibly high rate. We can see the 5-year dividend growth rate is sitting at 12.65%. So just look at the dividend yield on cost charted out. Let's scroll down. This is what their dividend yield has looked like, but this is what their yield on cost looks like. So for example, if you bought this stock 5 years ago, your yield on cost would be 6.72%. If you bought it around 3 years ago, it'd be around 5.5%. So yes, a low starting yield, but the yield on cost you're actually receiving grows every single year. And the reason they're able to do that is because free cash flow is growing at a high rate, which is also the reason that we've seen such amazing share price appreciation, and that's projected to continue to happen. And again, we can see I do have a couple of high yielders. My Ultra yield on cost, 9.36%, EPD, 9.4%, MPLX, a new addition to my portfolio, about 8.75%. Now, one of the things that I also track is my dividend income by industry, and this is an important one because it does slightly differ from simply tracking your sector allocation, because the example I always love to give is real estate makes up about 6.3% of my portfolio, but it actually makes up 11.7% of my dividend income. So it's completely possible to look diversified, at least from an allocation perspective. But when you actually track where your dividend income is coming from, you don't want it to all come from one sector. You don't want to be overexposed to any one sector. For example, maybe financials or maybe real estate took a heavy dive while everything else is doing well. At first glance, you could look diversified, but if all your income is coming from financials, that'd be a major risk to your portfolio. Now let's look at one of my favorite things to track over time, which is my projected annual dividend income. What do you notice about this chart? This chart only goes one direction. It only goes up. Now, that's significantly different from what we typically see from the S&P 500 or really any investment over time. Even great investments like the S&P 500 go through serious drawdowns. For example, we saw a significant sell-off in 2022. The market declined by over 20%. And if they were planning on simply using the 4% rule or selling shares during this time period to fund their retirement, all of a sudden their ability to actually retire was heavily reduced. That wouldn't be the case if they were using a dividend growth strategy, because the dividend growth strategy increases the amount it pays out to you in dividends every single month. Now, yes, part of this is because I reinvest dividends, but we have to remember, even if you don't reinvest dividends, it still grows because the underlying holdings are increasing the amount they pay out in dividends. This is what makes dividend growth investing so satisfying. Regardless of market performance, this number can continue to grow. Now, if we come over here, we can simply see my dividend income by each individual stock. Obviously, SCHD is the vast majority, but Vici pays out a lot. They paid me this month. Altria pays out a lot. They paid me this month as well, and so did Realty Income. So let's go ahead and take a closer look at all that. What we're looking at here is my dividend calendar, and I love the dividend calendar. You can see how much you got paid out each month, how much each position has paid you total, but most importantly, it allows me to actually visualize what the dividend growth looks like over time. The example I give every single time is Realty Income, and the reason I use them is they actually pay out dividends every single month. So you can see every single month, the amount they're paying me continues to increase because I reinvest dividends, and because every single quarter, Realty Income actually increases the amount they pay out in dividends. So just a few years ago, it was about $5, but as of this most recent month, it was around $30. So look at Coca-Cola, $23, Altria, $106, Realty Income, around $30, Vici, $131, JP Morgan, $16, and then a very small payment from Cisco. So all that adds up to about $308. It looks like December is shaping up to be my largest month ever because that's when SCHD will pay out again. So if we jump over, let's look at my dividend calendar. Now, all we're doing here is seeing exactly what days I was paid dividends. And we can see we've come a long way from 2022 when I was paid out $1,289 total, because we're already at about $5,259 through the first 10 months of 2025. So what days were good days? We can see I got paid out on the 1st. The 9th and 10th were both good days at over $100. And the 15th, I think that's when Realty Income paid. It was about $30, and then a couple of small payments to end the month. So we've been able to get through a lot so far, but we still need to answer the question of how long it will actually take me to achieve my long-term goal of one day living off dividends. Now, again, if you've been enjoying this video, keep in mind all the spreadsheets that you've been seeing me use are from tickerdata.com, and they allow you to automatically import stock financials directly into your spreadsheet. And if you look at the docs page here on Tickerdata, you can see that the attributes you can actually pull directly into your spreadsheet are pretty limitless. We have income statement metrics, statement of cash flow metrics, balance sheet data, and plenty of key metrics. And along with all this, one of the things you can see is you can actually import stock financials from companies all across the world: Argentina, Australia, Belgium, Brazil, Canada. We have a multitude of stock exchanges that you can pull directly into your spreadsheet. So if you're an international investor, that's not a problem whatsoever. But now let's go ahead and see how long it will take me to achieve my long-term goal of living off dividends. Now, my current portfolio value is sitting at about $244,000, and I prefer not to be over optimistic with the results that I'll see in the future. I'm projecting a price growth rate of 7% and a dividend growth rate of 7%, both of which are significantly below the historic averages for SCHD, but again, I'm not trying to be over optimistic. Now, the long-term goal is to contribute $2,500 a month on average. I know that's aggressive for many people, but that's the goal. So when we project this out, let's see what the results will actually look like. Now, one of the things we do have to keep in mind though, when we're talking about our cost of living and living off dividends, our cost of living will compound over time just like any other investment because inflation compounds like any other investment. So we need to get our monthly dividends above this black line, and we need it to stay above this black line. So let's see how long it will take to achieve this. What we can see charted out here in the red is my projected monthly dividends, and the black is my monthly cost of living. This is the point at which I could live off dividends forever. So let's see exactly how far away we are. We'll zoom in just a little bit more to get a better view. If we start scrolling down, what we can see is by year 5, we're still not there even though we're getting close to about $2,000 a month in dividends. If we keep scrolling down, year 10, we're still not there even though monthly dividends is around $3,700. One of the things you will notice is by then, monthly cost of living starts approaching $5,000 because again, inflation is compounding. But if we keep scrolling down, what we can see is about halfway through year 13, we get to the point where monthly dividends surpasses monthly cost of living. And one of the things we have to keep in mind, this is important, even if we stop reinvesting dividends at this point, we could still live off dividends forever simply because the dividend growth rate of our portfolio is above the rate of inflation. That's the key to being able to live off dividends sustainably. So let's get a higher level overview of this by jumping over to our investment dashboard. I'll go ahead and come down here just a little bit and we can see the future portfolio outlook. Now, assuming we don't reinvest dividends, 10 years from now, we'd be making about $31,000 a year in dividends. But if we do reinvest, it'd be all the way up to $42,000. Let's look at it over 20 years. It'd be about $77,000 if we don't reinvest. If we do, it's all the way up to $135,000. So you can see over time that compounding effect of reinvesting dividends plays a major role. And finally, over 30 years, if we don't reinvest, about $168K, but if we do reinvest, nearly $400,000. That's the power of simply reinvesting those dividends. And keep in mind, even if we don't reinvest those dividends, the results are still pretty phenomenal. So there you go. That's exactly how much I made in the month of October from a $244,000 account. Again, if you want to learn more about dividend growth and high yield strategies, be sure to check out dividendology.com at the link in the description, or you can scan the QR code that's on the screen right now. And if you'd like to download this spreadsheet or any of the other sheets you saw in the video, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.